Joining us now is Nomi Prins, author of many incredible books, an economist as well. She has published All the President's Bankers. It takes a pillage behind the bonuses, bailouts, and backroom deals from Washington to Wall Street. And her latest book, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Nomi, it's always a pleasure to talk to you.
Thank you so much, Anna. I'm very excited about this segment too.
Yes, you had previously written a book titled Collusion, not about Russia or any of that. It was about central banks and how they collude with one another and essentially game the economy on behalf of corporate interests. And I think it's really, really important to keep talking about that. And this book is kind of a continuation of that trend. And when you talk about permanent distortion, you're talking about the distortion between the asset economy and the real economy. So tell me what you mean by that permanent distortion. Why is there a disconnect?
Right, so first of all, yes, in my last book, I talked about the period really up through 2019, sort of pre-pandemic, and what central banks were doing to effectively create money, not effectively, actually to create money, lower rates, have an average interest rate of 0 for the banks and Wall Street and companies that could access it at that cheap level. Of course, real, normal, regular people in the real economy don't have that luxury, they still don't. But why that became permanent is when we got to the pandemic period, and everything was shut down. And all of us were anxious and we didn't know what was going to happen. All of that uncertainty was going on. The Federal Reserve decided to double the size of its asset book. It effectively went from around $4 trillion, it had been $4.5 trillion of money it just kind of created to buy bonds through Wall Street, to stick on its balance sheet, to hang out there doing nothing productive for anything. And then it doubled that amount to $9 trillion. And by doing that, in the pretext of helping the real economy, it permanently distorted the relationship between where money comes from and where it goes into the financial markets versus where it comes from and where it doesn't go into the real economy. And the reality is, since that time, is everyone has accepted the fact that for some reason, the Federal Reserve actually helped the real economy, which it did not.
I mean, I think one thing that Americans are a little more privy to right now is how the Federal Reserve, which, just to be clear, is an unelected body that has a huge impact on our economy. They're currently, through the increase of interest rates, having a very negative impact on the personal finances and economic situation for ordinary Americans. I want to go back to that in just a moment, but just to kind of further understand how this process works. It's different from just lowering interest rates, right? That's a separate thing. What you're referring to is quantitative easing.
That's right, and it still sounds wonky when we continue to see it today. It was wonky back when they talked about it in the wake of the financial crisis of 2008, when there was a bailout and there was $4.5 trillion of quantitative easing created by the Fed for the financial system. And it wasn't just the Fed, all the central banks, as I talked about in collusion, were doing the same thing, or at least the major ones were. The ones in sort of developing countries don't have the luxury of just being able to create money and have it go into their market system. This is a big country kind of thing. And in the wake of that quantitative easing and this particular period where the Fed doubled that, it's a way of effectively giving a credit line with no accountability, no responsibility, and effectively no interest or very low interest to Wall Street, and however that flows out into the financial markets. That's what it is. It's like we'll have rates here for ordinary people and a little bit for companies in Wall Street that has to deal with higher rates, but they pass it on, right? And then we have money, which is unattached to those rates, which just flows through. Money. Just literally fabricated. $41 trillion of money is currently on the books of central banks around the world. It was fabricated.
That's crazy. $41 trillion, guys. Understand, there's $41 trillion of fabricated money floating around the global economy.
Been floating around. And so it's no surprise, and a lot of that was created in the wake of the pandemic, but it was also accumulated through the financial crisis period. And so it's no surprise that markets are so unmoored anyway from the real economy. But when people need to understand fundamentally is this method is done to ostensibly help the real economy. That's the narrative.
That's the cover story.
That's the cover story. But that's not what happens. And we know this because of how much leverage the markets have had and how much they have outperformed the real economy when they go up and when they go down.
Okay, so let's talk about how that works, because the cover story is that this fabricated money is meant to, in a sense, it's a little different from trickle-down economics, right? But it's supposed to get to the real economy, in the form of loans, I guess, for small businesses and things like that. I mean, I don't fully understand what the cover story is, because what do they claim? How do they claim that money is supposed to get to ordinary people and benefit their lives economically? And the second part of the question is, what does Wall Street do with the money? That's an important part of it as well.
Right, and those are tied together, because ostensibly, yes, the narrative says that if there's a problem in the system, the economy shuts down, there's a financial crisis caused by banks, so we need to sort of help them give money away that ostensibly they will do, but we won't make them accountable to doing that. We will have no rules, we'll have no regulations to make them do that, and so they don't, because why would they? But what happens is this money goes into banks. The reason it does is because of how the financial system is structured. The financial system is structured in a triangle. The triangle is this: the government borrows money in the form of bonds, treasury bonds, and other forms of government bonds around the world. Those bonds get sold to the rest of the world, other central banks, pension funds, people, through banks.
Right.
Banks are primary dealers, they get it first, right? Then what they've been doing, because of quantitative easing, is giving it back to the Fed, who creates money out of nowhere to buy this debt back. So you have this triangle that just by definition doesn't go into the real economy. Although yes, it is supposed to go out in the form of small business loans, better conditions and credit for real people and everything else. We know that hasn't happened. In fact, it has flown into the markets. It has gone to the top of society, and it hasn't filtered in, not in wages, not in loans, not in small business growth, and not in any sort of fundamental long-term strategy that could help the foundation of the economy.
So there is that distortion between between assets and what we're experiencing in the real economy. And I mean, it's made me incredibly nervous, because while the wealthiest people tend to be the ones who are heavily invested in the stock market, you still have, retirement accounts associated with the stock market, ordinary people who've been saving, doing what they're supposed to do, and it feels like the stock market is this house of cards, right? These assets are just so incredibly inflated. And I keep thinking, all right, that house of cards, it's gonna topple over at some point. But it seems like anytime we get close to that, the Fed comes in and does more quantitative easing.
And that's exactly, and hence the term permanent.
Yeah.
It's not just that distortion which we're talking about, it's the fact that it's never going to change. Now, right now, yes, they are raising rates, and that is impacting everyone in society beneath the very top by more, because you have a one-to-one relationship with your money. Right now, the cost of getting a mortgage for an average home in this house has doubled in the last 6 months. So if you've been setting aside money to even make a down payment, now you can't, you gotta double the down payment, and then you effectively have to go buy more than that in order to just weed out the relationship between what you're borrowing and what rates are. So that's a problem. But also, just in terms of the height of how this works, there's a stat that I have in the book, and it always irritates me when I actually think about it, even though it's in my book. It's from Oxfam 2022. It's a recent report, and it says that this: in the 2 years since the pandemic, while all of this quantitative easing was whooshing through the markets, whooshing to the top, what happened was the top 10 billionaires in the world were making $15,000 a second.
Oh my God.
A second for 2 years. And the stat goes on, it says that if they were to lose, the market's going down a little bit now, 99.999% of that increase, they would still be wealthier than 99.9999% of the world. So when you just think of all those nines, and you just think of how that went out, that is one stat that fundamentally shows where this money went. It didn't just inflate their coffers, obviously it inflated the entire market system, but it did not go into the real economy. Our wages did not keep up with that.
No, our wages certainly have not kept up with that. And what's also fascinating is just like the juxtaposition between what Congress was up to at the height of the pandemic when it came to their constant debates and nickel and diming when it came to like stimulus packages, and how the Federal Reserve really was able to act unilaterally to immediately provide that fabricated money to the financial markets. It's pretty incredible.
Yeah, and they're not elected, as you said. They're not accountable. They're not responsible. We cannot fire them for doing anything that impacts our economic lives. And again, this is sort of global, although the Federal Reserve is at the epicenter of central bank movement. Other central banks almost have to do or have to follow what they do. Otherwise, their currencies, which are happening right now anyway, get crushed relative to the dollar, and that creates all sorts of other economic problems in countries outside the US as well, like additional problems. But yes, these people cannot be ejected from their roles.
It's crazy.
Even when they commit like crimes with trading, they can resign.
Yes.
But they don't get fired.
There was a huge insider trading scandal involving members of the Federal Reserve. Can you just briefly talk about that?
Yeah, and I talk about it in the book, but effectively one of the heads of the Dallas Fed basically resigned because it so happened it looked like he was trading into the policies of the Fed. You sort of trade in when money's coming in. You sort of take a profit once it's all seated there, or whatever it was that was going on. But there was a number of these situations going on, and even some of Ben Bernanke, not Ben Bernanke, yeah, time warp. Jerome Powell's Fed members were also, and it's an ongoing investigation, trading at times that were very conveniently connected to when the Fed was fabricating money and causing markets to go up on the back of the balloon of money. And so a lot of that stuff is still going on. A lot of stuff is still being investigated. But the reality is these people haven't been fired.
Yeah, no, and they're not elected. They haven't been fired. And it just feels like there might be, I never hold my breath when it comes to accountability at this point. But especially when it comes to insider trading that we've seen within Congress. There's been zero accountability on that. It's incredibly frustrating. I wanted to also just kind of touch on the topic of the Federal Reserve, rapidly increasing interest rates, which kind of shocked me because there's always been so much resistance to that. And Jerome Powell is very transparent about how, no, the target is to, increase unemployment, pain and suffering, among ordinary working Americans, and that will help lower inflation. And that's a cover story as well. And also it's incredibly cruel because it shifts the onus or the blame onto ordinary Americans who haven't seen their wages increase since the 1970s, right?
That's right.
So, but while all of that is definitely negative, what is your view of increasing interest rates? Because I think it's actually a lot more nuanced than raising interest rates bad, right? Because there is a positive element to it as well to some extent. I feel that the cheap money was definitely exploited, certainly by private equity firms who bought up literally entire neighborhoods of single family homes. That distorted the housing market and inflated the price of housing. Right. What are your thoughts on that? And is there a way to raise interest rates where there's less pain and suffering for ordinary people?
Yeah, it is really nuanced, and that is one of the problems, because when all of the ballooning was happening, when rates were at zero, when all the money was being created on top of that, it was going into private equity firms, it was going to BlackRock, it was going to Wall Street, it was going to all of those consortiums, and they were doing things like buying up neighborhoods. Well, right now, for example, there's a situation where they have those neighborhoods, and now they can charge high rents on them.
Yep.
Because, as I was saying before, people can't afford to even buy out some of the things that have been purchased by some of these firms and some of the bigger corporate consortiums of landlords, right? So that's a problem. So when rates get raised very quickly, particularly, we are in such new territory here, particularly after a period where they have been at zero for so long, or almost at zero for so long. They're up a little bit between 2015 and 2019, but pretty much at zero for a really long time. And all this money is being created on top of that, which doesn't go into the real economy. The problem is that the brunt of all of that doubling of interest rate payments for the average person hits them one-to-one. For Wall Street, for example, Goldman Sachs just announced its last quarter earnings. It had a really awesome trading quarter. Like, surprise, it just doesn't matter whether or not the market's going up and down, rates are going up or down. they bobble a bit, they come back up, but that cushion, the 9 trillion from the Fed, the 41 trillion around the world, that's there for them. It's not there for real people. So there is a way to raise rates to help people, but it goes back to how does it funnel through the financial system? How does that triangle work? If, for example, savings rates were actually going up as quickly as interest rates were, that could help. Now that said, it's hard to save if everything that you're paying for costs more, but it's just one mechanism where you could technically sort of rein in the banks. But the problem with this rate increase, this period, is just the veracity of it.
Yes.
And the fact that it's targeting wages. Now wages are not the problem with inflation. As it turns out, from 1979 to 2019, wage increases were 62% of price increases. But in the last 2 years, they're 8%.
Yeah.
They're nothing. They're not even keeping up with inflation.
I mean, the stat is incredible, but really, if you think about it, it's common sense. I mean, if wages haven't kept up with inflation since the 1970s, if we haven't seen an increase in wages since the 1970s, the idea that higher wages has led to what we're experiencing with inflation is insane. It's just insane.
It's completely, and it's a lie. And this is where the Fed is just, it's constantly dangerous, but at this particular period right now, it is super dangerous because it's lying to you. I mean, it's literally using the hot labor market, the increase in wages, to create a maneuver that is effectively, I think, political to make itself look better. Like, oh, we're fighting inflation. We finally noticed things were. We didn't notice when the top 10 billionaires went from $700 billion to $1.5 trillion collectively in 2 years, which we helped do. That wasn't inflation. We had nothing. Whatever. This inflation is something we want to hit, and they're targeting wages, even though what's actually inflating are costs in fuel, in food, in fertilizer, in transportation, in things that have nothing to do with anything the Fed can actually accomplish without really fundamentally tanking the economy, which I ultimately think it doesn't want to do, because then that's really going to piss off Wall Street. So it's staying in this sort of gray area where it's looking like it's fighting inflation. That accelerated rate hike is hurting real people fundamentally every single day. Yes, it's creating uncertainty in the markets, but the investors in the market will ultimately be able to be okay, and they have more cash set aside, as do the companies involved, to weather most of this little bit of an increase to them, but a very harsh increase as it's felt by real people.
It's incredible. I love this topic. It's really important. Everyone, please check out Nomi Prins' book, Permanent Distortion: How the Financial Markets Abandoned the Real Economy Forever. It's just excellent.